This is Business Weekend.
Hi and welcome to Business Weekend. I'm Edward Boyd. Coming up on the program today, Australia's economy now seems at odds with other global leaders, as our inflation problem is still here, but our interest rates have not risen like other countries. Today we analyse those differences and explain what it means for the nation and for the markets.
I just don't see how Australia can manage a cash rate of 3.5% or over without generating a recession.
Energy markets right now seem to be one of the most dangerous places for investors. But this year, there has been a change of control of the $5 billion AGL and now an $18 billion takeover of Origin Energy. Origin Chief Executive Frank Calabria is on the program. He's talking about why the re-engineering of our system must drive up prices.
We have an enormous opportunity before us to invest into renewables and storage and other supply assets as we build out this new system, and so I can certainly see that opportunity presents itself.
And the fight against the government's controversial industrial relations bill has united employer groups in a way not seen for decades. But the government presses on, determined to change the wage bargaining system. So all that and more on today's program. But let's start with the program with the economy. This week, New Zealand raised its interest rates by a further 0.75%. America, which at the start of the month raised rates by the same amount, also debated whether the supersized increases should start to taper off. But here, rate settings are also in the news. But it's about whether the Reserve Bank's current board should be setting the interest rates at all. This week, we heard some contrasting points of view from some of the world's central bankers. In New Zealand, Governor Adrian Orr delivered the country its biggest ever rate hike, lifting rates by 75 basis points to 4.25%. And in his commentary afterwards, he didn't mince words, warning the country will fall into recession next year.
Inflation is no one's friend, and in order to rid the country of inflation, we need to reduce spending levels. That means that we will have a period of negative GDP growth, we think to the tune of around 1% of GDP. So in that sense, it's a shallow period. And at the moment, we're saying that's around the second half of next year.
Back in Australia, RBA Governor Philip Lowe upset the government by warning wage increases would be a disaster, which would lead to even higher inflation and could trigger a wage price spiral, which occurred in the 1970s.
You can't get blood out of a stone. Look, real people are hurting without some wages movement. These wages changes aren't going to lead to double-digit wages inflation. Like, it's just rubbish. That's not what's happening. So a lot of these debates are theoretical. If wages move too far too fast, that's not desirable. But wages not moving at all is a disaster.
The review into the Reserve Bank kicked off in July, and this week the three members of the review panel fronted the media, saying they had received plenty of ideas from current and former RBA employees, business groups, economists and politicians. One suggestion was the RBA should split its board in two by having a monetary policy board and a management board.
On the pro side, it's really a question of clarity of roles and responsibilities and having the right people assigned to the right job, as well as kind of having a better ability to have an enterprise-wide view of operational governance like a regular board would do, while at the same time allowing the monetary policy group or the monetary policy board to really focus on those decisions and have the time that they need.
And to cap off the week, the minutes from this month's US Federal Reserve meeting showed that a majority of board members would like to start slowing the pace of the cash rate rises. The Fed has lifted rates by 75 basis points 4 times in a row, but now the next increase in January is expected to be 0.5%. So what of the future of interest rates here? But more importantly, the longer term trends, including our population growth and the rise of the Chinese and Indian economies. Earlier this week, I caught up with Diana Musina, senior economist with AMP Capital.
It's probably a reflection of the RBNZ getting more concerned about the inflation outlook based on the latest figures that we had from New Zealand that saw a much faster increase in inflation than anticipated, whereas in the US, we're actually seeing that goods inflation is turning down. I think that's giving comfort to the Fed that things are headed in the right direction. As well, the US Fed has done, well, now they've done the same level of interest rate rises really as the RBNZ, whereas the RBNZ only got there this month. So you could argue that there has been more tightening in the US and that's had more of an impact on the economy. The RBNZ actually telling us that they're going to hike rates quite significantly in coming months, but they don't meet again until February. So if you smooth out that one rate hike of 75 basis points this month, for the next 3 months, it looks a little bit softer.
RBNZ this week also talked about how they're expecting a recession in New Zealand next year. What about us in Australia? How are we faring next year?
Well, we don't think that the RBA will be able to hike interest rates as much as they did in New Zealand. So hopefully that will prevent a recession from occurring here. I mean, I think if we got a cash rate of 4% here in Australia and in New Zealand, they're forecasting that the overnight cash rate there will get to 5%. I mean, even if we get to a 4% cash rate here, I think that we would have to be forecasting a recession. So if we do the same level of interest rate hikes as New Zealand, well then yes, I think we will get a recession. But in our view at AMP, we won't need to do as many hikes to get the outcome that the RBA wants, which is lower inflation and some slowing in consumer spending to get that inflation down.
Yeah, Governor Orr in Parliament, I think, this week talked about how, in a way, they're trying to manufacture a recession in New Zealand because it sounds like the inflation concerns over there, are they much more serious there than they are here?
Not really, in my view. I think that in a lot of the developed world, we're facing very similar inflation problems. Goods prices have been too high. Services sector is now responding to that through higher wages, and that's leading to higher inflation in the services space, which is harder to get down, which is why the central banks are becoming more concerned about the inflation outlook. In New Zealand, the level of inflation is just over 7% on an annual basis, just like we have here. The level of that peak inflation is expected to occur at a similar level to here in Australia. Inflation expectations are a little bit higher in New Zealand, and also they're not coming down like they have in Australia, really. So maybe the RBNZ is getting concerned about that. But I don't really see too many differences between the New Zealand economy and in Australia. I suppose one thing potentially is that New Zealand's been a little bit more, it hasn't responded as much to those interest rate rises as Australia has, and we've had less interest rate hikes here. So maybe the Australian economy is more responsive to monetary tightening, and I think we are because our housing market is more vulnerable to higher interest rates compared to New Zealand.
Where does it leave our central bank with its last cash rate decision of the year in early December?
We think that we'll get another 25 basis point hike in December, and that will actually mean the end of this tightening cycle. The RBA doesn't meet again until February, like many other central banks, because they take January as a break. And we think that by February, things will look quite different in Australia. For the time being, we've seen that consumers have been quite resilient to those interest rate rises, but we think we'll see less of that resilience coming into the new year based on higher interest rates feeding through into mortgage rates, and also that the global economy will look weaker. I mean, this week we've already seen some bad US data, really. We're starting to see that the labour market looks to be turning in the US, and by February I think that we'll see more evidence that those rate hikes globally are working to slow down global growth, which I think will feed through into the RBA's deliberations. Even if we see another rate hike maybe in February or March, I think that we're very close to the end of this tightening cycle. I just don't see how Australia can manage a cash rate of 3.5% or over without generating a recession. And I don't think we need to get a recession here to get inflation down, because all of the leading indicators of inflation that I look at are pointing lower next year.
Well, this week we heard from the Governor of the Reserve Bank at a speech on Tuesday night, and he was basically warning about wage price spirals, saying higher wages will push up inflation. And then the government the next day seemed to disagree with this view, saying everyone deserves a higher wage and needs to be paid more. So who's correct here?
I mean, you can take it from both points of view. The cost of living pressures on households at the moment that we all know about, high inflation, rising interest rates, those are the reasons for why the government is trying to, comfort households by saying, well, hopefully you'll get a wage rise to compensate you for some of those cost of living pressures. However, as we know, rising wages feeds through into inflation. And while the RBA wants to see some wages growth, there is a sweet spot. you don't want to see wages running above 4% on an annual basis. The sweet spot is wages running between 3 to 4% on an annual basis, probably closer to that 3% level when you account for productivity growth, probably running at 1%. So we don't want to see runaway wages, which is exactly what you're seeing in countries like the US and even in New Zealand as well. They have stronger wages growth compared to us here.
This week you released a report outlining some global trends affecting economies and markets. One of the things you talk about is Australia's ageing population, but the working age population is in decline. So what challenge is this presenting us over the next 5 years or so?
Well, this is a problem that many developed countries are facing. Our dependency ratio is increasing, and that dependency ratio means that the level of the working age population relative to those who are aged over 65 or less than 15 years old, it means that we have less workers supporting those vulnerable age groups. Now, the issue with that is that we run down savings, because when you're working, that age group, that working age group contributes to national savings the most. When you run down the level of savings, that tends to be inflationary in a long-term sense. So over the next 5 to 10 years, I'm seeing more upside risks for inflation compared to before the pandemic. I don't think inflation will remain at 6 or 7% on an annual basis like it is at the moment, but we're not heading back to 2% inflation. I think it will run between a range of, say, 3 to 4% over the next few years because of some of these longer-term pressures.
Well, Diana Messina, Senior Economist at AMP Capital, thanks for your time today.
Thanks so much.
So how will markets and especially stock markets adapt to all this? When will those rate rises hit consumer demand, company profits and inevitably share prices? Well, let's bring in here Adam Dawes, Senior Advisor with Shaw and Partners. Adam, thanks for joining me.
Yes.
There was a big price gain for Qantas this week. Shares look like they're at the highest level since about February 2020. Is it all just due to high airfares?
Well, it looks like that, doesn't it? But really, I guess the way Qantas is looking at it, if the plane's not full, they're not going to fly. And so really, what they're doing is bumping everybody into these planes and making sure that they've got the full plane before they go. But it's also about pent-up demand from COVID. We're now starting to see that happen. And capacity is still there. So they are really starting to fly and doing quite well. But I think overall, Qantas is going to struggle in the new year because of that demand. That pent-up demand is going to slow down a little bit. And I'm just a little bit cautious about Qantas going into 2023.
Well, Qantas have had like 2 profit upgrades in the last 6 weeks. It just seems like a phenomenal turnaround for an airline that had billions of dollars in debt.
Yeah. I think they've benefited definitely, as I said, from that pent-up demand. They've paid down a lot of that debt, so that's good. Oil prices have come back down, so I think that's definitely helped them as well. But really, at the end of the day, everybody still, for the last 2 years, hasn't been able to travel, and so this is all that demand starting to flow through, and that's really what's really fueling, no pun intended, this Qantas boom that we're starting to see.
This week, we also saw a couple of retailers come out with some profit upgrades. Harvey Norman's one, Nick Scali another. Kogan looks like they had a pretty good week on the market too. Seems pretty positive right now for the retail sector as well.
Yeah. So Harvey Norman, I think, is probably the standout in all of that. They came out and said that their sales were up over 9%. Sales growth was up over 9%, so that was quite good. And they did say that after that sort of hangover from the lockdown, we're starting to still see that consumer starting to come out and doing a lot more spending. They also did say that they were going to look to grow in Malaysia, and that was really what I think the market liked, was that extra growth component of the story going forward. But I'm always, again, a little bit cautious about this demand that still continues to go on, because interest rates rising in the new year is going to really slow down some of those big ticket items that Harvey Norman, fridges, couches, those kinds of things, are going to suck on investors, as well as that drain on investors' wallets. So it's going to be an interesting one for the retailers next year.
Yeah, I wanted to talk to you about those rate rises, because the RBA's gone from 0.1 up to 2.85% in just 4 or 6 months or so. Yeah. And it looks like they're going to go to 3.1% next month. When are we going to start to see consumers cutting back?
Well, we saw the RBNZ just this week go up another 75 basis points, and that was a big move for them. And looking at that, we expect obviously the RBA to continue to keep the foot on the accelerator. But it really does show that this Christmas is going to be one of the best Christmases we've had in 2 years, due to the fact no travel restrictions Family's going to get together. Everybody's going to be okay. And they're really thinking, well, we only live once, so let's enjoy ourselves for this Christmas and we'll worry about the hangover next year. But that hangover is going to be quite big. Because if you've got a mortgage, $750,000 mortgage, you're going to be paying an extra $1,500 extra a month after tax. And that's really going to bite into that discretionary spend that we see consumers having at the moment.
Yeah, the RBNZ governor feels a little like the Grinch trying to steal Christmas. He's raised rates aggressively. He basically said he's trying to manufacture a recession in New Zealand. So he's obviously really worried about high levels of inflation.
Yeah. So they always go into restrictive territory, which is what the RBNZ is, in restrictive territory, and then they'll start to bring it down a little bit as they start to see that working, to then bring it back to a neutral rate where the economy is balanced. But that's a fine line, and I don't envy their job at all.
From a market's perspective, what are some of the sectors then that are at risk as these rates keep going up higher?
Well, obviously tech and consumer discretionary stocks are the ones that are going to continue to get hit the hardest, but markets looking 6 to 12 months out. So I think that it's probably looking a little bit like some good hunting area in that tech space at the moment. But certainly consumer staples, like I said, for Christmas, Woolworths and Coles are going to do very, very well over this Christmas period. And then certainly the materials sector obviously is doing very well as well. But yeah, it's going to be an interesting balancing act that we're going to see in 2023.
Yeah, the market obviously had a pretty tough month in September. I think it was one of the worst months in more than a decade.
Yeah.
But it's kind of on the way back up now, and it feels pretty positive as we head into Christmas.
It really feels positive, and even today and this week has just been a cracker of a week. And most clients' portfolios, they're ringing me with a little bit of a skip in their step. They're ringing me, look, everything's fantastic. Should we start taking some profits? So we've been sort of taking a little bit of profits in the coal space, the lithium space, because they're the sectors that have really, really benefited over the last, or for 2022.
The other thing we've heard about, the RBA governor spoke about it this week, Aussies have $250 billion in savings. They've saved it up throughout the pandemic. Do you think we're going to start seeing those savings being spent in retail stores over this Christmas period?
Yes, is one way to look at it. Yeah, absolutely, that savings. But I think also people will be worried about next year. But, and I think that they will look at that and their mortgage, and they'll be saying we've got to put a little bit of money aside for the mortgage, because Australians obviously will pay their mortgage before anything else. But yeah, absolutely, that discretionary spend, and we've seen those numbers coming through. JB Hi-Fi the other day had some great numbers as well. So I think the market potentially is looking ahead for Christmas is going to be a good Christmas, but reality is going to set in 2023.
So what sectors are you really liking right now?
Well, right now, obviously, as I said, we're taking some profits in that coal space. I've started to be doing a little bit of buying in that tech space, because I think that next year, midway through next year, as interest rates potentially come down a little bit, that's going to catch a bit of a tailwind. I'm also buying a lot of copper stocks at the moment. We know that the copper market is in deficit. We know Oz Minerals has been taken out. There's only one other large player in that space, and that's really starting to get a bid at the moment. So we're buying some of those copper stocks for that, hopefully 2023 to be a little bit better.
Thanks for coming on the program today.
Thanks. Have a great day.
Thanks, mate. Coming up after the break, we stick with the markets and look at the trend for mega takeovers in Australia. Plus, the subject of one of those takeover offers is Origin Energy. We speak with Origin Chief Executive Frank Calabria about the future of energy prices. Thanks for being here with us on Business Weekend. In the first half of the year, takeovers and mergers amounted to more than $150 billion. 25% more than the previous year. And the pace of those takeovers has not let up in the last 5 months. Ross Greenwood spoke with Tony Damien. He's a partner in the mergers and acquisitions team at law firm Herbert Smith Freehills, and asked him what's driving these acquisitions in such volatile economic circumstances.
Ross, it is a volatile time, but there are these vast pools of capital looking for a home. And in the context of a volatile world, Australia, with some pretty good assets, isn't a bad place to be investing, and we're seeing a lot of it. We've had a real spike towards the end of this year, and I expect that to continue into 2023.
OK, so if you look, say, for example, right now, you've got the UK going into recession, you've got New Zealand going into recession, most likely the United States going into recession, Australia potentially avoiding a recession. Is that one of the attractions as to why all of these mergers and acquisitions are potentially starting to seek targets here in Australia?
Absolutely. I think that's one of the reasons. So when you look at the world, Australia is a pretty good place to be investing. great assets, but also a lot going on in areas that are of interest. So the energy transition, Australia, I think, will be right at the forefront of that, and that's why we're seeing a lot of interest from overseas in that sector as well.
We'll speak in a little while with Frank Calabria from Origin Energy, but that's one that sort of raised my eyebrows as to why it is that Brookfield and others are so attracted to that area when there's so much uncertainty about what the future of energy is going to be. But then I start to rethink, and I wonder if this is true. They have the energy. That's the key for the future.
No, indeed. And there is a commitment to that future state of energy. We may not all know what it looks like precisely and when we get there, but there are people who are committed to it and are putting their money behind it. And we've seen that, real dollars going into it, and I think we'll see a lot more of it as well next year.
OK, so then the big area of mergers and acquisitions over the past 12 months has been in the healthcare space. Just explain why. I mean, there's been a giant bid from Ramsay Healthcare from KKR, which now seems to be off the plate. But that's been the big deal. It's but there's been all sorts of other smaller ones around the edges as well.
Yeah, health is an area of great interest to people. It's an area for the future, I think. When you think about the industries which are going to be around and become more important, I'd say health is right up there. And that's why for those pools of capital, private equity and others, they'll be looking at a lot of health assets. Ramsay was obviously one situation. There were some others, and there will be others as well, because I think health is an area of the future that people have a lot of interest in.
Now, there's a strange commonality in Origin and also in Ramsay Healthcare, totally different businesses, but KKR private equity. In the case of Origin, it's Brookfield, again, private equity in a different space. So there is now different organisations wanting to make these takeovers of public assets. That's one of the fundamental changes.
It is, Ross, and that's a real driver. I'd also add to the mix that in terms of pools of capital, we've also got our own superannuation funds, and we're seeing them invest directly into assets and really doing some big deals as well.
All right, so the superannuation funds are also fascinating because you're right about the size and the scale. In the past, they preferred to have the liquidity of publicly traded assets. In other words, ASX companies, they'd hold a whole bunch of shares here or overseas. Now they're prepared to have a pool of their money in illiquid assets. In other words, the subject of either big returns in income or that in the longer term, they can make bigger deals with those. So that means the dynamics of who makes these takeovers fundamentally changes.
It does indeed. And Australia's biggest takeover, Sydney Airport, who was behind that? A lot of superannuation funds doing exactly what you said. So taking a publicly listed asset, taking it private, and I imagine they'll be holding on to that for some time. OK,
so they hold on to it for some time, but those superannuation funds then have to go through the process of having managers who can still run the entity. I mean, it's all very well to suddenly say, right, we've taken it over. It's another thing to say we're the owners, but now we also need to run the entity. Is this something that occupies the minds? Because certainly private equity, they've got a track record of being able to manage and run these things pretty aggressively, get value out of them, and then resell them. There's always a view to the resale down the track. With the big super funds, I just wonder whether there's a similar view.
I think it's slightly different. I think it's a longer-term horizon. I think that's probably good for the assets, and I think there's early days, but there's a track record already for the super funds of being able to be smart enough and to run these assets well, because there's nothing in it for them if they're not running the assets well. So early days, early signs are good, and we'll see more of it and see how they go with it.
But then it strikes me that with the size of superannuation assets in Australia, now more than $3 trillion, which is bigger than the value of Australia's stock market, there is almost nothing that is out of bounds on the stock market that big superannuation funds here and private equity could not tackle. There's no company big enough. So there's a whole bunch of other companies we might be seeing in the future become takeover targets simply because their returns are seen to be attractive long-term to those superannuation funds.
Could not disagree with a word you've said there, Ross. What I'd add in as well is don't forget that even though these pools of capital are so big, if the business that they're looking at has a number of different divisions, they can team up, as has happened on Origin and some other deals. And so not only can they have a go at any company irrespective of size, they can team up to do it as well.
So the other thing about that, Tony, is when you look now at a lot of public companies, you go to the annual meetings, you can see that those institutional shareholders, the superannuation funds, the industry super fund, they're very active these days, be it on executives' remuneration reports. If they own the assets themselves outright, they have complete and utter control over all that process. That's one of the attractions.
Oh, it is. And you're right, there is a lot of involvement these days. The sort of passive institutional shareholder, those days are gone. So they're absolutely active commentators on a whole range of issues. And when they own the assets, they won't be commentating, they'll be doing. So it'll be interesting to see how that pans out.
Tony Damon from Herbert Smith Freer Hills, many thanks for your time.
Thanks, Ross. Great to be here.
The subject of one of those takeovers is Origin Energy, now subject to an $18 billion approach from a consortium led by Canadian investment bank Brookfield. But Origin is at the centre of Australia's energy crisis and its transformation being a so-called gentailer, which retails and generates electricity. This week, Ross Greenwood caught up with the Chief Executive, Frank Calabria, who took an upfront approach to explaining the cost and consequences of the energy transformation.
Yes, Ross, it's an exciting opportunity to be able to decarbonise the energy system, and it's great that the government have set a 43% emissions reduction target by 2030. But what we do need to achieve that is a very large infrastructure build-out of billions and billions of dollars. That's got to be paid for and therefore comes at a cost. And I think we need to take the community along with us on the way to have an honest conversation about the cost of the transition. And we all know we want to get there because we want a decarbonised energy system, but it's going to take a lot of investment to get there, and that's going to come at cost to customers.
Well, you put the number at $76 billion needed to be invested by 2030 to achieve all this. Where does that money actually come from?
Yeah, that comes from Labor's investment plan that they announced, and that was their estimate of the cost of the energy infrastructure this decade to get to that target.
So does it come from government or from the private sector? Because ultimately, who's going to pay for it, the consumer or the taxpayer? Because somebody clearly has to bear that cost.
Yeah, that cost will be invested by both the private and the public sector, so certainly the government will be playing a role in that, but a large portion of that energy infrastructure will be coming from organisations that are investing in both transition, renewables and firming capacity over the balance of this decade.
But what seems to me is it's inevitable that if you've got all that capital cost, it's going to add to the price of power for both households and businesses. And for businesses, it undoubtedly will make them less competitive. That's what they're paranoid about.
Yes, so it will come at a cost because obviously it's a significant amount to be invested. Clearly what's happening over time is that there'll be the introduction of more renewable energy and storage, and there's no doubt that over the longer term we expect that will have a lower wholesale cost of energy, but nevertheless we've got a lot of investment to undertake between now and then, and that cost will need to be recovered, and as a result that's why I think we need to connect the ultimate goals with the ongoing investment and take the community and customers along with us.
There's just one thing, Frank, I think might be lost in all this argument, and that is the priority right now to decarbonise the industry, or is it actually to keep the lights on? What is the number one priority? Because I'd imagine in my heart and mind that the number one priority should always be to make certain the lights are kept on and that power bills are affordable.
Yes, well, the number one priority is to keep the lights on, and everyone works hard on doing that every single day. And I'd have to say so do government's focus on that, so we as an industry are focused on that. At the same time, we've got goals that are being set, and we also support achievement of those goals, but that is going to require a lot of investment in relation to emissions reduction, and we need to achieve both. So your first priority is lights on, and then over time it's actually to reduce the emissions associated with the production of energy.
So what's the priority is to keep the lights on? Does that mean we have to make pragmatic decisions about the future and longevity of coal-fired power stations? That we simply can't achieve both goals, in other words, keeping the lights on and also the energy transition to a carbon-free future if we go too quickly down that decarbonisation front?
Well, certainly I think the industry participants and governments are making pragmatic decisions about coal and the way that leaves the sector. There's no doubt there's a lot of supply coming into the sector as well. So there are pragmatic decisions being made all the time. I think we're getting to the point now where everyone's announced, or there's a lot of announcements to accelerate the closure of coal between now and 2035. I just think it's important that that happen in a coordinated and orderly way. And I think that's the best outcome for customers, but whilst at the same time achieving the decarbonisation or the emission reduction targets that have been set.
So do you have any feeling as though it can be done in an uncoordinated way, and this could lead to a disruption in the energy markets, price spikes like we've seen in the past 12 months, and also the potential of shortages, outages of electricity?
Yeah, what I'm focused on right now, Ross, is the fact that we need to build the low emission system, and that's taking longer. So there's more infrastructure that needs to be built, and those projects need to be underway. Transmission projects need to be completed for more renewables to come in the system. A capacity mechanism needs to be introduced to get more backup firming capacity built. And so while we are going to take time to get that new system in, and by the way, we need to act urgently in that regard, it's very important that the existing power system continues to perform reliably, and I think we need to recognise that's where coal continues to play an important role, and we need it in there for only as long as we need it, but it needs to be there until we've built that low emission system.
Well, when I spoke to the Treasurer Jim Chalmers a couple of weeks ago, he said he thought he has three options. One is to basically hand out compensation to households and businesses, but he says he can't do this because it's inflationary. Number two, he said he could potentially put in some sort of super profits tax on energy companies and raise money to provide the support. But he said this isn't his preferred option, though clearly they're going to have a look at it. Third is regulation, to enforce the current voluntary agreement that sees uncontracted gas from Queensland go back into the local grid rather than being sold overseas. Now, he says this would be his preferred option, but is it your preferred option?
Oh, I think it comes down to the design of all of those. Clearly, the government is assessing what's the best way to do that when it's a difficult situation to solve. It would really come down to the detail of those regulations. I think what they're very much focused on, as I understand it, and it really is a matter for government, but as I understand it, I think they've been very clear that they want to understand the various consequences and get the best solution in what's a difficult problem to solve. And if that's the preferred course, it would really come down to understanding the detail around that to see if that's workable.
OK, but is the danger or the risk there potentially that if gas that would otherwise go overseas to support the energy needs of other countries that, remember, have committed tens of billions of dollars here into Australia to build these plants, that would risk bad faith with those countries if we force the gas back into the local market?
Oh, I think the government, and it's a matter for them, but I think they're very well aware that they want to preserve contractual arrangements that have been undertaken with other countries. I think this is all about understanding about how they best deal with higher gas prices. Remember, our gas prices are well below those that are paid in export countries, but they're higher than they were when customers would have been previously contracting. So I think it's all about ensuring that that supply and price of gas is competitive in Australia. And I think that's where their focus would be. I think Australia does really understand the role it plays more broadly with long contracts, and I wouldn't be expecting that to be the issue here.
Now, I know the takeover by Brookfield is fairly fresh, and I know there's still things to be done here, but as Chief Executive of Origin, can you see what it is that Brookfield sees in Origin right now? Because a lot of people would see this as potentially a very dangerous place to be investing in right now, the Australian energy market.
Well, when you look forward, the energy transition is an enormous opportunity for the investment of infrastructure and the production of both renewables and storage over time. And I can see that Brookfield, through its announcement about wanting to invest $20 billion into that renewable opportunity as the new energy system's built out, is a very large opportunity. They've been a long-term investor in Australia, and they see that as an exciting opportunity, as Origin does, by the way. And so there's an opportunity to really accelerate that over time as we go through our own transition. So that's it's that view of Origin as a platform from which to do that I believe is motivating their bid for Origin.
Frank Calabria, always good to chat to you. Many thanks for your time.
Thanks very much, Ross.
Stick around, because after the break, we take you inside the government's quest to change Australia's industrial relations system. But it's meeting fierce opposition from business groups. Welcome back. This week, employer groups ramped up their opposition to the government's rapid introduction of new workplace laws. The main fight is over the reintroduction of so-called industry-wide bargaining versus enterprise bargaining, which has been the way most people's wages have been negotiated for the past 30 years. Ross Greenwood this week spoke with Joellen Munton, Executive Counsel and Team Leader at Harmer's Workplace Lawyers.
I believe, Ross, it was driven out of a fundamental need for change because it's become apparent over recent years that the original shift to enterprise bargaining, an enterprise bargaining model rather than an industry-wide award-based model, has not produced the results that governments had expected it would. It's been largely a failure in changing our system to one which is generally based on collective bargaining or enterprise bargaining. Very few people now have their employment terms set by enterprise bargaining. They're all on awards, and those awards these days are a very, very minimalist safety net. The original intention of the legislation when it was first introduced in the Keating years was to move to a system where the labour market generally would have the benefit of an enterprise bargaining-based system. Different iterations of the legislation have attempted to progress that aspiration, but it's largely been a system that's only benefited those very heavily unionised sectors like, construction and mining, where there are strong unions and there are big employers. There hasn't been much access to enterprise bargaining in other areas. And we're particularly noticing the effects of that now in terms of low wage growth, a declining share of wages of GDP now, profits share increasing considerably, wages share decreasing. We're seeing real productivity growth over the last 20 years, but employees are not taking a very much of a share of that of their own productivity contributions at all. Okay. And that is largely because the enterprise bargaining system hasn't worked so well.
Okay, then take me to a few aspects of this, because it is complex, I understand. One of the aspirations is to get some better gender equality. Where has that failed under the enterprise bargaining agreements? Because surely that was enshrined into law that there should be equality of pay for equality of work.
That's right, but the thing is that we have what we often call feminised industries, where there hasn't been a strong culture of enterprise bargaining. And so there just hasn't been the kinds of changes that have been expected. Nurses and teachers, childcare workers still earn low wages relative to people, in the trades in, say, the mining and construction sectors. Now, this bill, one of the aspects of this bill that's not getting nearly so much attention as the multi-employer bargaining aspects is a considerable improvement in the Fair Work Commission's ability to look at pay equity, and particularly in the care and community sectors, and to make some much needed improvements to the awards in those sectors. Now, those aspects of the bill are very important, and hopefully they will get through. The whole bill at the moment is being held up by what I might call the usual argy-bargy of a political nature over the one aspect, which is the multi-employer bargaining questions.
So let's go to that, because that whole notion of the industry-wide bargaining or the multi-employer bargaining, this is where the workplace has changed over even 30 years as well. One aspect which is quite clear is that a lot of employers got into significant trouble because it was so complex they didn't understand how much they should be paying workers, or used the system to deliberately underpay workers for a period of time. But that being the case, I just wonder whether going back to an industry-wide bargaining, because workplaces are so fundamentally different these days, whether that really does benefit the country in the way in which it should.
Well, look, I think it's an overstatement, Ross, to say that this is in fact a bill that would move us to industry-based bargaining. In fact, the changes in the bill are relatively minor, and all they really do is open up the scope for two streams of bargaining that are presently available in the Fair Work Act but are not much used, to expand access to those a little. And they are the what used to be called the low-paid bargaining stream that was intended to allow people in low-paid areas like, cleaning, security, where the workforce has been fractured over the years. It's a high use of contractors now rather than direct employees, and lots of little contractors with small numbers of employees, all in fact providing services to, for instance, one large hotel chain, for instance. The idea of the low-paid bargaining stream was to allow those people who are in fact working in the one enterprise, if you think of the notion of an enterprise from an economic point of view rather than a legal point of view of how many different little companies are involved. But that scheme, introduced with the Fair Work Act in 2009, hasn't been very effective. I think there's only been something like 2 low-paid bargaining authorisations made and no agreements made under that. Now, this bill proposes to just open the scope for that scheme a little wider and calling it the supported bargaining stream, and it would allow for workers who were in fact bargaining in that stream access to the usual protected industrial action system that we have now for enterprise bargaining. That prospect has seemed to have struck fear into the minds of employers that there might be strikes in those areas. But I would say that there's very unlikely to be strikes in those areas because those workers are still lowly paid. They still can't really afford to lose a day's pay for industrial action. The rules that are put in place still require there to be a majority of workers in each little enterprise within the group to agree that they want to take any industrial action before it can happen. So I suspect we won't see very much real protected industrial action happening in that area at all. I do hope, however, that the new rules would open up the scope for at least some bargaining.
From Harmer's Workplace Lawyers, Geraldine Munton, many thanks for your time today.
It was lovely to speak with you, Ross.
The change to the IR laws has brought business groups together to challenge the government. This week on Business Now, we spoke with the head of the Australian Industry Group, Innes Willox, and here's a little bit of what he said.
So we have enormous concerns about it, as well as the rights of unions to strike and around the role of the Commission here. Essentially what the government is doing is handing this over to the Fair Work Commission and saying, you work it out. It's just going to be a lawyer's picnic. So as you said in your question, it's united the business community in a way that the business community has not been united for years.
So what of that opposition and the impact of the changes, especially industry-wide bargaining on small business owners and operators? Alexi Boyd is the CEO of the Council of Small Business in Australia, COSBOA, and she joins me now. Alexi, a couple of months ago you stood side by side with the unions at the Jobs and Skills Summit, broadly supporting these IR changes. Now you've done a bit of a U-turn. What has happened this week that's driven that change?
Well, look, when we stood at the Jobs and Skills Summit, we were supportive of finding simpler and flexible arrangements for small businesses to be able to employ people. We also had a memorandum of understanding to have a conversation about what we can do to work together to make that actually happen. That's what was basically discussed. Unfortunately, because of the largesse of this bill and how complex it is, we have not had the opportunity to do that. We are all focused on working through this bill and trying to make it as applicable to small businesses as possible, give the small business perspective, and that's what we're focused on right now. What we're focused on, importantly, is trying to make the IR system a process that small businesses can engage with, that actually gets them employing as many people as possible, make it simple, make it fair. But ultimately, down the road, we need to look at the modern award system to make it more appropriate and reflective of the modern workplace.
Were you sucked in by the rhetoric from the unions? How unhappy are your members right now?
Look, what our members are focused on is trying to get through this bill and understand what it means for their small business cohort. Essentially, there's a lot of parts to it. There's a lot of impacts on small businesses, and we're working through what those unintended consequences may be for small businesses of all sectors of the economy, and that's where the focus is right now. And so we're working with the government, we're working with the crossbenchers, and we're working with the independents, everybody who wants to make things better for small businesses. But importantly, we need to see some action designed to protect small businesses from the unintended consequences of that. That's what our members are focused on. We met with them recently and they are saying that they're hearing from small businesses there is a real concern about the multi-employer bargaining. We're reflecting those sentiments.
The business lobby groups AIG, ACCI, Business Council, Minerals Council, they've all come together. It seems, though, that your business group has been at odds with them. Are you going to work together now with the overall business sector to try and improve this proposed legislation?
We made a really clear statement a couple of weeks ago that came together with the other business groups, saying that now that we've had the opportunity to see the bill, see what what's part of the bill, the potential unintended consequences for small businesses, that we believe alongside the other business groups that firstly the multi-employer bargaining needs to be carved out, examined very, very carefully, given everybody the opportunity to show what that perspective is. And from our perspective, that's what it will mean for small businesses. But importantly, we need to look at what this carve-out might look like, and it needs to reflect what small businesses are right now. If you look at a small business, they are not 15 headcount. That's a teeny-weeny business that may employ a few casuals, perhaps school-aged children, and that's how they make up their workforce. That is not a big business, but that's what we're looking at saying. It's got to be reflective of the modern workplace, and 15 headcount is simply not it anymore.
Is the big fear multi-employer bargaining will result in strikes? One example might be you own a chicken shop and a chicken shop 3 kilometres away down the road has a problem with its employees. They go on strike and then your own staff then go on strike as well to support them. So how big an issue is this going to be?
What we haven't had the opportunity to do is to go back and forth with our members to really get what those small business case studies would mean under different circumstances. And that's what we're seeking. We need more time to be able to offer those examples and say this is where the concern is. But right now, after speaking to our members, what we're hearing back from them is that small businesses are very concerned, and we have to be reflective of that. They're worried about what it might look like. And there's multiple parts to this bill. There's multiple changes. And as we keep saying to government, every area of policy affects small business. Any reform in any piece of policy, the knock-on effect is that small business owner has to spend more time doing the admin, filling out the forms, figuring out what their needs are, what they have to do to be compliant, and less time working on their business, growing it, and in fact employing more people. What we're concerned about is this bill is a disincentivization, or it disincentivizes employment for small businesses. We want to see more people being able to be employed. We want to see the flexibility in that employment process to encourage more small businesses to take on employees.
The government wants to rush this legislation through before Christmas. Do you think that's achievable now with all the opposition to the bill?
We'd have to leave that to the government to pursue the timelines, but what we are seeking and what we're really asking for is to give us a reasonable amount of time to be able to prosecute such a difficult, complex bill. Like I said, there's many aspects here that could have consequences for small businesses. An organisation like ours and an organisation like ACCI and BCA, we all need time to understand what the consequences could be and be able to feed that information back to government so that they can make an informed decision. And we're very much aligned with Senator Lambie and Senator Pocock, who are seeking more time for just that to occur.
Do you think your organisation has taken a bit of a reputational hit over this? Are your members happy right now?
Absolutely. We've got support from our members in terms of what it is that we're seeking, but it's an evolving conversation. They are giving us feedback now because they've had the opportunity to look at the bill, wash it through their membership, find out what their concerns are. Like I said, that all takes time, and we're finally at a place where we can actually start to feed that information back again. But the concern from our members is that we need to see this bill slowed down. We need to see it broken up into parts, particularly the multi-employer bargaining, which is causing the most grief and concern for small businesses. And so what we need to see is that happening at the very least, and then we need to work through the process with government, and that's what they're asking us to do.
Alexi Boyd from COSBOA, thanks for your time today.
Great to chat, thank you.
So that's it for the program this Sunday. Up next, all the latest news right here on Sky News. Business Weekend returns next Sunday, but don't forget you can keep up with all the latest business news with our daily program, Business Now, at 4:30 p.m. and 11:30 p.m. Eastern Daylight Time, and via our website, skynews.com.au, where you can find a replay of this program. Thanks for your company today. I'm Edward Boyd. We'll see you next week.